Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. I'm preparing this video today to talk to everybody about recessions and bear markets. You know, it's no secret to most of you that the stock market has officially entered bear market territory, which simply means it's dropped more than 20%. And there's a lot of talk about the U.S., entering a recession. And that always worries investors. I know I talk to a lot of clients myself, and they're always scared and they're always nervous. And there's always this perception, I believe, at least from what I've experienced, that people are afraid they're going to lose all their money and not be able to retire, or they're going to, suffer during retirement and so on. So I'm going to try to put bear markets in perspective with this video and a couple follow-up videos that I plan on doing in a short series here. One thing I think is important for me to say, and I don't want to be glib about this, I want to be deadly serious. I actually embrace bear markets. As a value investor, bear markets are the best markets there are because they're markets that give you the opportunity to invest safely in common stocks, whether they're high quality or not, simply because the valuations are low enough to provide you a margin of safety and protect you from the future, and also do things like increase your yields and so on. So I'm going to talk about ways to position yourself in a bear market and how you can actually not only make money, but actually accelerate your profits. And, the real bottom line is the first step in this process comes from the old statement that is, considered good advice in nature, and that's never run from a bear. And the key is you want to face a bear market as an investor. You want to use it as an opportunity to acquire stocks or to pick up sound investments and to position yourself for long-term growth. Now, I want to emphasize that investing properly and positioning yourself properly for bear markets and recessions is all about investing for the long term. So let's go ahead and get into it. And let's start by looking at a recent Wall Street Journal article that was titled, "If the U.S. is in a recession, it's a very strange one." And there was a lot of good information here, and you might want to take a look at the article. It was published a couple of days ago. But what I really want to point out here, and I want to use this to talk about the duration of recessions compared to the duration of bull markets. So this article went back to 1948, and that recession lasted 11 months. Then we had one for 10 months, 8 months, 10 months, 11 months. In 73, it lasted 16 months. That was one of the longest. 6 months in 1980, another 16-monther in 81. And then, the more modern times, since 1990, it was 8 months. The 2001 recession also lasted 8 months. The big one, the 2007 and 2008 recession, lasted 8 months. And then, of course, we had the COVID flash crash, which was only a 2-month recession. So recessions tend to be short-lived, okay? That's an important thing. They're usually measured in months rather than years, okay? I think that's important. But in contrast, I came up with an article here that was published in 2020. So it's a couple years old, but it was talking about visualizing the length and growth of every modern bull market. I thought this was interesting. So let's go over the numbers of the bull markets in contrast. In 1966 to 68, we had a 26-month. That was longer than any recession. And then 31 months in the 1987 to 1990. And then we had, the Nifty 50, which ended up being 32 months long, just short of 3 years. And then we had JFK aims to get Americans moving again recession. That was in 1962 to 1966. That lasted 4 months. World War II, we had a bull market that lasted 49 months. The Cold War ramps up. It lasted 50 months. The housing boom this is more modern now, from 2002 to the 2007 before it crashed. That lasted 60 months. We had the Reaganomics recession, lasted 60 months. We had the 1974 to 1980, lasted 74 months, 86 months. And then we had the roaring 90s that lasted 113 months. And then we had this most recent bull market we've been living through that went from 2009. Now, this was to present, which was 2020, which, of course, came the flash crash, which was a temporary interruption, not really an eruption. So this one's lasted 131 months and counting. So putting that all into perspective, bull markets tend to last a lot longer. Now, I want to talk about how do you protect yourself from a bear market and how can you actually make money in a bear market. And I think one way to do that is go back to the wisdom of Ben Graham, who produced the seminal, value investing book, The Intelligent Investor. And he has a quote in here that I want to share with you because I want to try to focus on this throughout this video series. And that's called Dividend Growth Stock Investing for Safety and Income. And of course, the key phrase there would probably be safety, because that's what you're looking for in a bear market. But I also want to basically emphasize that bear markets give the opportunity to make outsized returns at below average levels of risk. And I think that's such a critical thing, as long as you don't get too scared, because ultimately in the short run, markets are driven by either fear or greed. And I've always said fear is the worst. And, the bear market itself won't hurt you as much as how you react to the bear market. And I'm going to go through some examples here for you, but let's start by go ahead and reading this quote, because I feel, this is something I've felt very strongly about for quite some time now. And that's, a company's dividend record. And Ben Graham felt that one of the most persuasive tests of high quality safety in a company is an uninterrupted record of dividend payments going back over many years. We think that a record of continuous dividend payments for the last 20 years or more is an important plus factor in the company's quality rating. Indeed, the defensive investor might be justified in limiting his purchases to only those stocks or companies that meet this test. In other words, we want dividend growth stocks as a dividend growth investor if we're investing for the long run. So let's start out by looking at examples that we don't want to own. And I want to emphasize the aspect of valuation, which is so near and dear to my heart. Coming into 2002, General Electric was one of the companies under Jack Welch that was participating heavily in this financial debacle that really was the, ultimate precursor to the Great Recession of 2008 and 2009. It had to do with housing and loose money and free money and so on. And what you had here was companies like General Electric were trading at, first of all, very high valuations relative to what the orange line here, which would be theoretically intrinsic value. But value and growth are joined at the hip. And the problem was General Electric also had falling earnings during this period of time. And this white line is the dividend. And they also were cutting their dividend. So in this bear market, this is what I think people are really afraid of. In this bear market, investors in General Electric saw almost 80% of their money disappear, and rightfully so. The stock was overvalued. It performed operating-wise very poorly, and it also, cut their dividend. Now, they had a pretty good streak of dividends going, which might somewhat, contradict Ben Graham's case, but there's an exception to every rule, and this was an exception. But the key was you would have still, as a good value investor, avoided General Electric because the valuation didn't make any sense. And of course, the company's never really got their mojo back since then. As you can see, they did come out with a few good years coming out of the recession, but then they've kind of been suffering again. So one thing is avoid companies like that. But let's look at some of the examples of really quality dividend growth stocks here. I want you to see those. Let's look at a company like Johnson & Johnson. Now, again, there's a valuation lesson here. Johnson & Johnson being a AAA rated company, one of only two, on the planet, and being a very consistent earnings generator. You can see their orange line was uninterrupted going up. Now, it averaged about 8% a year during this 20-year plus time frame I'm showing you. But the point is the stock was overvalued coming into the recession. It was reasonably valued during the recession. Then it became undervalued, at the throes of the recession. And what a great time to be investing in Johnson & Johnson stock, because from that time going forward, you could have generated over 12% annualized rate of returns investing in a company only growing at 8%. And it offered you a pretty stout dividend yield at that time. So if we look at dividend yields during the time when Johnson & Johnson's price was about the lowest here, you were able to get 3% plus yields. And during this time when, the stock was undervalued, you could get 3.5% yields, in contrast to 2.5% today when the stock is highly valued. But here's the emphasis I want to get out of this one. This high-quality company, price valuation was the issue, not performance, not the ability of the company to make money. You can see their earnings grew very nicely. They did slow down growth a little bit. That was the extent of the recession hurting them. I want you to note that their dividend increased from 162 in 07 to 180 to 193 to 211, and it's continued to go up since. This is a classic example of that uninterrupted dividend that, Ben Graham talked about. The next stock I want to look at is another one that's a dividend king. This company's increased their dividend for 50 consecutive years. Now, I do want you to notice this company is more cyclical. If I take price off the graph, you can see that the earnings itself have been, semi-cyclical. Every now and then they have a down year or so, but their growth rate on average has averaged 12.5% from point A to point B here. When you put price on the graph, these are weekly closing stock prices, you can see again, importance of valuation. The stock was overvalued coming into this period of time, and that led to an extended period of time of poor performance, even though the company didn't do that badly. And this is prior to the earnings actually collapsing here, I'm showing you. But note the dividend. The dividend grew year after year after year after year, and right through the recession, 52 cents, 60 cents, 68 cents, 72 cents. So if you pay attention to valuation, only be willing to invest, as I've often said many, many times, when you can find a margin of safety, number one, to protect yourself, from long-term damage, and also position yourself for outsized growth. You want to buy them, as Warren Buffett once said, you want to be greedy when others are fearful and fearful when others are greedy. And again, you can see that high valuations are always the riskiest time to invest, and low valuations are always the best. Now, Dover has recently, come into fair value. There's not a whole great deal of margin of safety here, but what I'm trying to suggest is it's time for you guys to start thinking about that. Another example would be Blackrock. Now, Blackrock as a company has grown by 15.5%. They never really got significantly undervalued. Occasionally, they dip below the orange line, which represents the intrinsic value calculation, if you will. You can obviously see periods of overvaluation and how the price always comes back to fair value. I talk about that all the time in my videos. And you could see that recently the stock was very highly valued. Now, people were loving this. I often tell clients and anyone who will listen, actually, that I live in money manager hell. I'm usually most excited when I see, in recessions and when I see things being bad. My clients at that point are usually almost, morose and despondent. They're suffering, and yet I'm giddy as all get out. But during these high valuations where everybody was so happy with this long-running bull market we had, I was scared to death. I couldn't find anything that I felt comfortable investing in. I was, afraid of the risk. My dividend yields were lower than, they would normally be. You can see that clearly by using this dividend yield overlay that we have on fast graphs, that when the valuations were highest is when the dividend yields, were lowest on these companies. And, I'm trying to get the highest yield I can at the least level of risk I can, and then position myself to participate fully in the growth of the business. And you can see Blackrock has now started to come into value. That's just another example of a AA rated, very high quality dividend contender. Now, a dividend contender is a company that's increased their dividend for 10 to 25 years, in contrast to the dividend aristocrat who's done it for 25 years or more, and a dividend king who's done it for 50 years or more. These, I believe, are the best shopping areas that you have. And here's another one, which is another dividend king, more than 50 consecutive years. And again, I want you to notice what really happened. The company itself performed admirably. It did have some down years during the recession, and the stock price, of course, this was, somewhat vulnerable to that because it was in building and housing, home improvement, obviously. So you can see the company did suffer a little bit, but the dividend income continued to increase. And again, you get your highest yields when your valuations are lowest. And this stock has been really trading at what I consider to be lofty valuations for the last decade or so. But it wasn't so bad because the company was also growing at almost 20%. This was a very strong housing market and so on and so forth. But the key point that I want to get across here is the recession created an opportunity to pick up this great stock at a lower valuation. And that's, the real thing. So what I'm going to finish this video with is just an overview of some things that I want you to see. In future videos, I'm going to show you some of the opportunities that are available today. But I'm going to start with dividend kings in value. These are 14 dividend kings. Abbvie is actually a spinoff from Abbott Labs. It's technically still considered a dividend king. You can see it's still very inexpensive with a nice yield. Now I'm just going to go through these. I want you to see that these are stocks that are trading below the orange line. ABM Industries. Now this is not a real fast growing one, but it has increased their dividend. If you look at the performance here, their dividends increased by 3 or 4% a year, slowed down a little bit in recent years, but again, that's the nature of the beast. But again, I'm going to go through these very quickly here. Dover, I've already covered with you. Fuller Brush, you can see that, the correction is taking place. What it's doing is this correction, this bear market, is giving us opportunities to start seeing some of these companies become, available at attractive valuations where you get the best yields. Like here's Leggett Platt at almost a 5% yield now. It's a pretty cyclical company, but it's got a very solid dividend record of increasing their dividend year after year at about 5 or 6%. Now, some years it's slower than that, some years it's faster than that. That's, just the way things, happen and work. I'm going to go through these very quickly. Lowe's, I've already covered in terms of, what's been going on, but you can see the dividend, the company is becoming reasonably valued. 3M has become very attractive with almost a 4.6% dividend yield. Buying the stock when it's below the orange line, so to speak, when the valuations are really sound, really is an awesome opportunity. Anytime you could have done that in the past, even at today's low valuation, you would have made double-digit rates of return. But there would also be periods of time that are actually, 7, 8, 9, 10 years here where your rates of return could have been just exceptional, over 20% a year. There you have 3M has become one that's reasonably priced. Altria, the old Philip Morris, I always call symbol MO, it's very inexpensive with almost an 8.75, great long-term dividend record. National Fuel Gas is one that's a little bit different. We do have a dividend. This is a dividend king. They have a very good dividend record. Their growth record has not been that great, but you know what's been happening to gas prices. And, this is a gas utility, and the company started to make money, and you can see the stock prices responded, but technically, the stock is still at an attractive valuation. Parker Hannifin was recently overvalued. It's come into fair value. Stephan Company, a specialty chemicals company, great dividend record, was really overvalued. A lot of volatility here, but you're starting to, get into an area here where you can buy the stock cheaply. Stanley Black & Decker, I think, is extremely inexpensive today with almost a 3% dividend yield. Target has actually had, a bad year, but, what a great time to be looking at maybe taking a position in Target, this dividend king that's, increased its dividend for 50 plus years, and it's been averaging, double-digit dividend growth over just the last couple of years. So you can see that the opportunities are starting. Here's Tennant Company, industrial machinery, great dividend record. It was very, very expensive, too expensive for my taste. It's now become, reasonably priced. Going to go in now to Aristocrats. These are companies that raised their dividend for 25 consecutive years. I got 14 stocks in this list here. What I really want you to see is I want you to see this correction process. I'm going to go back to operating earnings here. You can see these stocks were really overvalued during this quote-unquote bull market that everybody loved. Clorox even got a nice kick from the COVID. You can see it beginning to correct. Dover, I've already covered. Ecolab has corrected dramatically. Emerson Electric has corrected. Lowe's, which I've covered several times now. Medtronic, 3M, I've already gone over. Pentair has now become very reasonably priced as a dividend growth stock. PPG Industries, look at these corrections. And that's the danger and risk of overvaluation. There's Stanley Black & Decker again, and there's Target again. There's T. Rowe Price that is having a bad year, but the stock price is way overreacted. Notice this company not only pays a growing dividend, but they pay special dividends quite often. Then, go on to VFC, the old Vanity Fair. Now, this company, this chart's a little weird. I do want you to notice something, that this company went from a December fiscal year end to a March fiscal year end. So that kind of messes this chart up a little bit, but you still see the valuations were crazy back here. And now it's come into a more valuation, friendly territory. Now, these are dividend contenders. These are the companies that have maybe only been paying dividends for 10 to 25 years. They have little different growth histories. But again, I want you to see what the correction is doing. Agilent is still, in my way of thinking, very overpriced, but you can see the correction process has started. The bear market is actually cleansing the market. Accenture, great company. I'd love to own this one if I could buy it a lot cheaper. It started. It hasn't gotten there yet. But also, I want you to understand that when you're investing in this area here, when you're investing down here when the stock is cheap, recovery is usually almost imminent and very quick when you're investing at high valuations or not. Here's Analog Devices coming down. AES is getting cheaper. Amgen has been a decent value stock. Ameriprise is inexpensive. This is the old Anthem, symbol still ANTM. It's basically a managed healthcare company, very excellent company. You can see the correction started here, not quite where I'd like it to be. I've covered Blackrock. Cummins has gotten inexpensive, very cyclical, but again, focus on the dividend, focus on the white line here. The dividend has been very stable, so you can buy this at a 3% yield or higher. This is an opportunity for you to position yourself for the long run. First Republic Bank of San Francisco, Globe Life is inexpensive. Home Depot, just like Lowe's, very similar graphics. Honeywell, I was asked to cover here recently. Honeywell is still nowhere near where I would invest in it, but it's certainly a lot better investment today than it was 6 months ago, and I think that's the real point. Intuit, look how much this stock has fallen. That's the real risk over valuation. There was no fundamentals supporting those high prices back there. People just need to accept that. JP Morgan is very inexpensive. Lennox has become very inexpensive. This is, if you're not familiar, it's a building products company. Lockheed Martin is still overvalued, but the correction process might be starting. McKesson has actually been defying the bear market, but it's been one that's been undervalued. And you can see what the advantage, the reason I showcase this one is so you can see the advantage of undervaluation. You got to be patient when a stock is undervalued because most of the time stocks are undervalued. There's a reason. There's some reason why people are, down on the stock where the sentiment is negative. But that's be greedy when others are fearful, be fearful when others are greedy, as Buffett said. Snap-on has become inexpensive. Spire, which is another gas utility, is still expensive, but you can see how overvaluation was a real poor time to buy it. So anyway, that's what I got for you today. This is Chuck Harmel saying, hope you enjoyed this video. What I'm really trying to showcase here in part one is how bear markets are really nothing to be afraid of. In fact, bear markets should be something you should relish. If you got dry powder, it may be time to start, building up some cash reserves. And it may not be time to enter this market yet, but you can start putting your ducks in a row, if you will. That's what I'm doing. I'm already making a list of the most undervalued stocks. There's plenty that I think are available now. And the key point here is I'm not trying to buy at the very, very bottom. That's really not the goal here. For example, if you look at one like Stanley Black & Decker, which I consider very inexpensive, I would have been a buyer anywhere in here, anywhere the stock was, let's say 20% or more below fair value. I'd have been willing to buy it, up in this area. If the stock has continued to fall a little bit, but I'm positioning for the long run. I'm positioning to own this for 10 or 20 years or more. As Warren Buffett also said, the best holding period is forever. What you're trying to do with these dividend growth stocks, to go back to that Warren Buffett quote that I think is so important, and I'll close the video with that. It's the most pervasive test of high quality. And if you're focused on the income and the dividend, you can position yourself safely and you can actually get enhanced profits and do better in a bear market than you can in a bull market, because every bear market ends with a bull market and every bull market ends with a bear market. The good news is bear markets tend to be short-lived. Bull markets tend to last for a long period of time. So invest wisely, invest safely. And, for those of you who are especially at or near retirement, look at dividend growth stocks. Having that dividend is such an important aspect of protecting your money, but also helping you make money. If you enjoyed this video, give me a like, ring the bell, subscribe to the channel. Also take a look at Fast Graphs. You can see what a powerful tool it is just by looking at this video. And then, stay tuned. I'm going to be showing some examples of dividend growth stocks that I think are viable today, regardless of whether they fall anymore. They've already got such a margin of safety built in them, in my opinion, that they are attractive buys. I'll be covering those in forthcoming videos. Thanks for watching, everybody.